All right. Hey guys, welcome to the webinar. It's 8:05 p.m. on October 20th. This is our first Team Take Profits trading training, the advanced class week 1. All right. So we're going to start getting you guys to understand what you actually need to do to find profitable setups when you're scanning the market yourself. All right. Obviously, you guys know you have swipe trades. It's been killing it. You know you have the harmonic scanner. We're going to try to show you how to implement that into your trading. And ultimately, just want to let you guys learn this skill as well. So take notes. You're going to have a recording of this. And obviously, we're going to expand on it week to week to week to week. The other trainers will as well. But we need you guys to understand the baseline before we can get too specific on any one thing. All right. So I call this the advanced class. It's going to be more than just simple support and resistance. All right, guys. But remember, this is an ongoing thing. So you're not going to master trade when you leave the call tonight. But over the next month or 2 months or 3 months, as we continue to do this, I expect you guys to know what you're doing. All right. So stick with me and let's go to work. So a little bit about me first. For those of you on the call who don't know me, my name is Matt McCormick, 26 years old from Michigan. Graduated from the University of Michigan in 2013 in mechanical engineering. I really just leave that bullet point there so that every webinar I can say go blue, right? I'm a full-time engineer for the U.S. government, and I've actually been successful in Forex trading since high school. Go blue, I like it. We got to go blue in the chat box. Actually been successful in Forex trading since high school, so a little over a decade now. Typically, I average about $12,000 a month in profits from trading, and my career earnings are approaching 7 figures. All right. So I'm gonna ignore Rob's message. So the cool thing about this, guys, and it's what I liked about IML when I first saw it. I've been involved in other things in the past. I'm successful with other things at the same time. You'll see the first picture there. A $220,000 check was presented to me back in 2015. And that would be a lot higher now if there was another event. So I've been successful with a lot of things in the past, doing different product-oriented things online. Not really big recruiter in anything, but just finding systems that allow you to generate money without recruiting if you don't want. So besides myself earning hundreds of thousands of dollars, I've had the opportunity to train hundreds of people to build meaningful incomes online as well. And to me, that's pretty cool. Even here in Michigan, quite a few of my friends have 6-figure incomes simply because we've been able to introduce them to something like trading. All right. So, I've told you guys on calls in the past, this isn't an overnight skill by any means, but there's definitely a ton of money in it if you stick with it. All right. So that's a little bit about me. Hopefully that gives me the credibility that you guys will pay attention to what I have to say, and you can take it and make your own money from there. All right. So always got to do this at the beginning of every webinar that I do, at least. It's a disclaimer, and I want you to take it seriously. This isn't to scare you away. This is just to make sure that you're using proper risk management and trading smart. All right. So the disclaimer is this: trading involves significant risk. Although the risk when trading Forex can be fixed for each individual trade, the trades are live and it is possible to lose an initial investment, particularly if a trader chooses to place his entire investment to a single live trade. It is highly recommended the traders choose a proper money management strategy, which limits the total consecutive trades or total outstanding investment. You must be aware of these risks and be willing to accept them in order to invest. Don't trade with money you can't afford to lose. And this presentation is neither a solicitation nor an offer to buy or sell stocks, futures, currencies, commodities, or options. And guys, no representation is being made that any account will or is likely to achieve profits. Past performance is not necessarily indicative of future results. All right. So obviously we've made money in the past. We expect to make money in the future, but you never know, right? There is risk involved in this. Don't be trading with your rent money. Don't say Matt's strategy is flawless. It's never going to lose, and over leverage your account on a single trade. All right. So just be smart about it. This isn't there to scare you away, but it is there for a reason. So pay attention. All right. So let's go on to the next slide. Here's our agenda. Not too many points tonight, but a lot of information to go through. We're going to just start looking over the team training schedule just so you guys are aware of what we're setting up for you. We actually have a website in the works. It's just about done. that we're going to start introducing you guys to and getting you guys hooked up into. And that'll have all that information. But I just want you to see it tonight so that you can start planning around it. Okay? And we're going to talk about why we're here. Why Forex? What do we expect to accomplish from this? We're going to look at different types of confirmation that you can use when you're looking to enter a trade. We're going to do a quick review of the technicals. We're going to look at my favorite type of trading, a combination of convergence and correlations, and then we're going to have a Q&A session. All right, so let's get going and knock all of this out. So here's our team webinar schedule. Me and Justin and Curtis and Tom and Rob and David and Joe, we all met about a week and a half ago for hours, and we talked about a lot of different things. One being the website that I mentioned a minute ago. Two being getting you guys consistent, ongoing training that can build upon itself so that we're not just constantly stuck at, getting on here and showing you beginner stuff every single time, right? Obviously, we need beginner stuff. We understand that as new people come in. But we want to give you guys building blocks that you can continue to build off of, right? And actually learn how to do this. So you can see the training schedule on there. We have, I believe, 16 days of the month. 16 days of every month are covered with different trainings. And then every Thursday we have live opportunity meetings in Detroit for in Justin's office in Southfield for anybody that wants to bring prospects to that. So if you take a look at the webinars, Justin is going to be doing team building training every other Sunday. Mondays are pretty much booked every week. We have mindset training from David on the first and third week of every month. Joe's going to be doing marketing training on the second and fourth of every month. And as far as marketing goes, you have the second and fourth week of every month. You have Freddie doing marketing training as well. So for those of you guys that are interested in the affiliate side, we have you pretty much covered at the start of every week. All right. So Justin, Freddie. If you don't know Freddie, he was a huge builder in the last company that I was in with him. Really good at YouTube training, stuff like that. Joe and Justin are just great marketers in general. So you're going to have a lot of training from those guys as far as building the comp plan side of this. As far as the trading side of it goes, Curtis, whom everybody on this call knows, professional trader, does it full time. He's going to be training you guys every other Tuesday. I'm obviously going to be training you every other Friday in trading. And then for beginners, for new people that come on, we have Rob doing an IML tools training. He's on the call right now every other Wednesday. And then we have Jay Wayne doing a basic trading session every other Saturday. So, one of the things we heard loud and clear from our team was that our training is too inconsistent, a little bit repetitive, for always focused on new people. And we wanted to answer that, as loud and clear as we heard it. So here's what we came up with. So you guys can screenshot that. For now, it'll be on the website once we have it up. And we hope that this will speed up your learning curve on both sides of this company. So that's what we have planned. Okay. So guys, you saw this. This is what I put on the post earlier to introduce the webinar. The last thing you want is to finish something and wish you would have worked harder, right? So, like I said, you're not going to learn everything in the next 2 hours on this call. That being said, I want you to take this stuff and I want you to study, right? I want you to keep going to IML Academy, IML TV. I want you to look at the market. When we get off this call, look at the market. The market's obviously closed right now, but look back at the market and see where these things that we go over would have applied. See where your entry points would have been, where your exit points would have been. Would the entry point have won or lost, right? Where would you get out? And keep in mind that this is a lifelong skill, right? So, whether you're winning now or not, whether you're profitable now or not, whether you're taking your own trades now or not, keep in mind, like I said, there's literally hundreds of thousands, if not millions of dollars involved in this. And the more that you can practice and train yourself to do it, the faster you're going to get good at it. One sec, guys. I have somebody asking me for the link. Okay, there we go. Okay. All right, sweet. Okay, and a little bit of inspiration for you guys. A couple quotes for you, right? Benjamin Franklin said, an investment in knowledge pays the best interest. And Jim Rome said, formal education will make you a living. Self-education will make you a fortune, right? So it's great that you guys are taking your Friday night to be out on this call. Obviously, the more you learn, the more you earn. And to me, this is the way to do it, right? Obviously, like I said, I still have a full-time job. Don't necessarily need it. But, this is obviously the way to go, all right? So keep that in mind that right now you're investing through IML in education. Take advantage of it. Okay, so here's a sad fact for everybody. And not to start the webinar off on too sad of a note, but check it out. At age 65, out of 100 people, only 3 are financially independent. 19 are still working. 7 are dead. And 71 out of the 100 at age 65 are dependent on family or state. And to me, these are staggering numbers. Obviously, you can't control it. Well, to some degree, you can't control if you're one of the 7 who are dead or not, right? But assuming you're not, you have a 19% chance to still be working. And on top of that, you have a 71% chance that you're dependent on somebody else, right? You could still be working and be dependent on somebody else. So obviously, staggering numbers. They say that 76% of people, even while they're working, are living paycheck to paycheck. So keep in mind that, if you do what the average person is doing, you're likely to end up, in that group of average people who clearly aren't where they want to be when it's time to retire or time to enjoy their life, right? So where will you be, right? Will you still be here 2, 3, 5, 10 years from now trading, learning how to do this, mastering this skill, making a lot of money? Or will you fall back into this big blue part of the pie, right? So keep that in mind that, you may not have heard of Forex before, but a lot of people haven't, and look at where they end up, right? So let's talk about trading now, all right? Let's move into what we're here for tonight. So the first thing I want to talk about is confirmation. Okay, when you're looking to take a trade, all you're doing is analyzing the market and trying to find enough information that lines up to confirm that a high probability setup exists. And that's all you're trying to do. All you want to do is find enough reasons to take the trade. Okay? And by high probability, I mean that it needs to be profitable over the long term based on the trade's risk to reward ratio. So, guys, if I use terminology that's new to you, keep in mind that this is advanced training, right? So I'm to some degree expecting you to have went through IML TV. I'm expecting you to have, went through the academy to kind of have an idea of some of this stuff. And obviously, if you're new, take advantage of the more basic trainings, right? So I'm not going to go through and break down every vocab word in this training. But if you have a risk to reward ratio of 2 to 1, right? So I'm going to risk $100, but I want to win $200, right? Then I have to win some percentage greater than 1 out of every 3 trades. Right? I don't need to win every single time, right? If I lose $100 once, if I lose $100 twice, and I win the $200 once, right, I've broken even. Win 1 out of 3. Anything above that is profitable. So I want you guys to take win percentage with a grain of salt whenever you see it, okay? If you see a 99% win rate, but the person loses $100 when he loses and makes 50 cents when he wins, that's no good either, right? So keep in mind that it's more than just win rate. It's more than just being able to say, I won 90% of the time, or I only won 25% of the time. I suck, right? That's not necessarily the case. So all we're looking for is a high probability setup where the math works out profitably, all right? So there's multiple types of confirmation that we can look at. Number one, you can look at multiple time frames. You can say, okay, well, it looks good on the 1 hour chart. Let's look at the 4 hour chart. Let's look at the daily chart. Is anything sticking out as far as, maybe I shouldn't take the trade? Is there things that confirm that I should, right? And we're going to do analysis on multiple currency pairs as well. So, maybe I'm looking at the euro dollar. Can I find something on the pound dollar that tells me not to take the trade or to take the trade? And we're going to look at that tonight. So analysis includes price action, market structure, indicators, and oscillators. All right, now I can't go through all of these in one webinar tonight. So obviously I'm going to see you guys back here in 2 weeks, right? But, there's a lot that we need to look at. But once you get this down, okay, are we going to look at multiple time frames? Yes or no? Are we going to look at multiple currency pairs? Yes or no? Let's look at the price action on them. Let's look at the market structure, the indicators, the oscillators. It should just be a checklist. You go through the checklist, either your confirmation meets the criteria or it doesn't. You take the trade or you don't, right? So big note, confirmation isn't only about looking for reasons to take a trade, but also for reasons not to take a trade, right? If I see 3 or 4 or 5 reasons to take a trade, stuff lining up, but I see one big red flag, don't take the trade, why would I jump in on it? Right? The market's not going anywhere. Wait for the good setups. Okay, there's no reason to jump in on something that potentially could go the wrong way when you had a big warning flag telling you it could go the wrong way. Okay. So a little bit of a recap for those of you who are new to IML, new to the call, haven't seen things before. We will go over some of the stuff tonight. But again, I hope to wean off of it fairly quickly. So support and resistance. Support and resistance lines show horizontal levels in the market that price has trouble breaking through. Okay, price tends to, but doesn't always, bounce off these levels and reverse direction. We call that the bounce. Okay, and I want you to keep in mind that everything we talk about tonight, it doesn't always happen, right? That's why we need to combine different things to increase our probability of it happening. Okay, so the market's not perfect, people aren't perfect, and no trade you take is going to be perfect. So that's where risk management and stuff comes into account. But if price hits a support or resistance level and then bounces off of it and reverses, we're going to call that a bounce. Okay? If a level is broken, price often continues strongly in that direction. We call that a break. Okay, so the level broke and price broke out. Okay, often broken support levels become resistance, and broken resistance levels become support. So let's take a look. Here's a support and resistance chart. So you'll see here we have a support line, right? The price comes down and hits it, and the next time it gets tested, comes down and hits it and bounces again. It hits it and bounces again. It hits it and bounces again, right? And the way that this is explained, and might sound confusing to you guys, but I want you to try to break it up in your head. Okay, the more times a level has been tested, the stronger it is, right? You've heard in IML they consider the support level the floor, right? That you can't break down through the floor very easily. Well, if you keep jumping up and down on the floor and it keeps holding, then it's a pretty strong floor, right? But keep in mind the market doesn't do everything forever, right? Doesn't do everything forever and ever. So even though that level gets stronger every single time it bounces off of it, you need to be aware that eventually it's not going to bounce off of it anymore. And that's a little bit contradictory, right? If it gets stronger, why would it break through it eventually? Well, because it has to break through it eventually, right? So stronger to a degree, but with the understanding that eventually you're not going to be able to play this 100 times, right? Okay, so finally we come here, and then we break, right? This is what we call the break. We broke through the level, and then like we projected, it moves strongly in that direction. Now, I don't want to take a trade. Some people do this. Some people play the breakout, and you could play a breakout. You could say, I'm going to watch it break, okay? Watch it break, and then I'm going to enter this trade for a sell down here, and I'm going to put my stop loss just a tiny bit above the support level, right? Now, if the market breaks down and comes back into my zone, I only lose a few pips, right? I only lose a few pips because I'm putting my support level right up there. I don't want to tender back in the zone. If it does, I figure I lost, right? There's no reason to put it way up here, right? You need it down here. So then if it continues down, then obviously you make a good amount of money. What I like to do is actually play it more out here, okay? So they say broken support becomes resistance, right? And you'll see that. Here was a support level, came down, it tested it, and now it acted as resistance and bounced back off of it, okay? But to me, it's not a support. A broken support is not a resistance until it shows itself to be a resistance, okay? In order for a resistance line to be resistance, I want to see that it's been resistance before, and I think that only makes sense, right? I think that's safer. So price comes down, it comes back up here, it bounces and acts as resistance, comes back down. Okay, now I'm happy. Now it's been resistance. Now if it comes and happens again, right here is where that potential setup would be, right? Again, stop loss just above the level, for a sell off this bounce where it's been a strong support level. It's proven itself to be resistance. You enter here and you come down. Okay, so this to me is the safest entry point in this picture. Same thing over here. Broken resistance becomes support. So here, resistance, boom, break. And then you'll see that we bounced right here. Your entry, in my mind, will not be right here. Okay, I just didn't take a ton of this picture. You'd be waiting for this to respect again and start to actually form some kind of a trend. All right. Okay, so that's support and resistance for you. Nothing crazy there, but that's kind of a little bit of a play that we can make. Okay, so a trending versus a ranging market should be reviewed again, but in a trending market, price is generally moving in one direction. Okay, pullbacks or partial retracements are fine. It doesn't have to move in one direction continuously, and it won't move in one direction continuously. But generally, we need to be moving in one visible direction. Okay, and in an uptrend, we're looking for higher highs and higher lows. In a downtrend, lower highs and lower lows. And that would make the price swing in that direction, right? The opposite of a trending market is a ranging market. So price is generally moving between specific highs and specific lows. And hey to everybody who joined the call, awesome. So in a ranging market, we're not setting new highs or new lows for the time period. And market movement appears to be horizontal or sideways. Okay, so let's take a look. Here's a trending market, right? You can see clearly that we have a high right here and a low right here. Okay? Then we have a lower high right here, a lower low here, lower high, lower low, lower high, lower low, and like we said on the last screen, that creates a downtrend, right? This creates a simple downtrend. Price is typically moving lower than it started. Okay? Let's see here. Let's see. All right. So now a ranging market, right? And this is what a ranging market looks like. Basically, we're moving between 2 points, right? We're coming up to our level, down, up, down, up, down. So basically, a ranging market is constrained by a support and resistance level. Support and resistance level, right? Came up and hit the resistance, came down and hit the support, hit the resistance. And price is fluctuating between these two levels, okay? Now, keep in mind that there's a difference, and a lot of people in IML accidentally use the two terms simultaneously, right? There's a big difference between a range and consolidation, right? Consolidation is a word IML likes to use, but this is not consolidation, okay? When the market's swinging between 2 points, that's just what it's doing. It's swinging between those points. Consolidating means that it's tightening. Okay, so when you hear consolidation, you'd be expecting price to be tightening almost to a point, right? At least to a very tight zone. So maybe if it was coming up here, come down here, maybe it only comes up halfway, and then it comes down to here, and then it comes up a little tighter, and a little tighter, and a little tighter, and then you're moving in a tight zone, okay? So you can trade a channel differently than you would trade consolidation. Typically, for a new trader, you guys just want to avoid consolidation in general, all right? It just means a dead market, not a whole lot of volume, not a whole lot of movement. There's not a whole lot of reason to be in on that. But there are things you can do with ranging markets. So I want you guys to keep in mind that that they're different, okay? Craig says, what time frame do you recommend analyzing the support and resistance, the daily? So typically, for support and resistance, you're going to be looking at the 1 hour, the 4 hour, and the daily. Okay, 1 hour, the 4 hour, and the daily. And typically, I actually look at those in the reverse direction. The daily first, put some daily resistance and support on there, and then work backwards. Typically, I look at the higher time frames for things like the oscillators, the RSI. You know, same with the daily time frame. I don't want to be buying if the daily time frame is overbought. Okay, and we'll go into stuff like that as we move along. But as far as time frames, my main time frame that I do most things on is going to be the 4 hour chart. Okay, and that's just a good middle ground. All right, you know, you don't want trades that go on forever and ever and ever and ever. Although I do occasionally take trades like that, particularly things like oil. I'll take trades that last for months, right? But for you guys with smaller account balances just starting out, You want trades to last, be intraday or maybe within a week. Maybe you'll ride it out 2 weeks, right? And it's something that we're going to have to get used to, is that you can't expect every single trade to just jump in it, go your way, and get out by the end of the day, right? There's no reason for that. You have to remember that we're investing for real, right? This isn't a game. It's real investing, and not everything's going to happen in 10 minutes, right? So we need to get past just sitting there and staring at it. Once you have the trade in, you need to do your analysis, be confident with the trade, and then win it or lose it, right? But don't be afraid if it. I have people on my team that, even with the swipe trades, they will enter and they'll be flat for a little bit and they'll jump out because, well, it wasn't going anywhere. Okay, keep in mind, things can take time to play out. That's okay. Okay, so here it is all put together, trending versus ranging, right? And guys, for whatever reason, I've been randomly coughing kind of bad for the last month, so I'm just kind of stopping every once in a while here to take a drink so I don't hack all into the webinar, right? But okay, so here it is combined. So obviously here the market's ranging. You had a little breakout right here. The price went strongly up. You got a retracement down. Okay, you had a little trend line here that kind of lined up. You came back up, came back down. You entered a ranging market again. So you had an uptrend into a ranging market again. And remember, coming off an uptrend, a ranging market tells you this trend is potentially over, right? It doesn't necessarily mean we're going to go down. But when you start to see weakening of movement like this, you should be concerned about this uptrend possibly ending, okay? It did set a new high right here, right? So, that's okay. But, you're still tight here. So here's where you wouldn't want to play a breakout, right? And we'll talk about that. Same thing here. We broke that to the downside, came down into a downtrend, entered a ranging market again, and came back down into a downtrend. So there's something called the ADX, the Average Directional Index. It's one of the indicators you can add on your MT4. And, typically, once you've been trading for a while, you probably don't need it. You can probably recognize if we're in an uptrend or a downtrend or a ranging market pretty easily. But different people look at that differently and look over different amounts of candles or on different time frames, like Craig mentioned, right? So the ADX helps to, break it down for you if you're in an uptrend or a downtrend. And you'll see that if the ADX is less than 25, then the market is ranging. So if you add an ADX to your chart, take a look down here. Here's your 25 line. Down here, when the market was clearly ranging, it's less than 25, less than 25, less than 25. When it was trending, it's more than 25. Really, we're only looking at it for the ranging parts, okay? So, if you're looking to take a trade based on the market trending and you see that ADX is 20, again, you might want to avoid that because the market might not really be ranging like you think it is. Okay, so take note of that. The ADX, the Average Directional Index. Okay, so another thing we can do is trade trend lines and channels. Okay, so to trade a trend line, all we're doing is locating two major tops or bottoms and connecting them, which is pretty easy. And what we're going to get is a diagonal support or resistance. Okay, so take a look. Here we have, let's look at this point right here. Here we have an uptrend starting to form. So we take point A right here and connect it to point B right here. And we draw that line and extend it out. So imagine that everything to the left of this, or to the right, sorry, of this trend line isn't there when I drew the trend line. All right, I started here, I drew it up here, and then the market started to play out, right? And you see that the market respects that trend line. We bounced here, we drew a line. We came down, we respected the line. Came down near the line, respected it. Came down, hit the line, respected it. Hit the line, respected it, right? Now, if we extended this a little bit farther, right here's where we broke the line, and then we're gonna start to be worried about, and you can imagine if that was extended up, maybe I should have extended it up more, but you can imagine that right here, if I extended it, we would have broke it on this candle, and now we got to start to be worried, and you see a little bit while later, down we go, right? Same thing can be done with the downtrend. You connect point A and point B, and you see it respected that trend line at point C, right? Boom, down we went, okay? Obviously, here we have another sideways channel that you could play off of, okay? So to create a channel, we need to draw a parallel line at the same angle as the trend line and move it to where it touches the most recent peak. Okay, so this is important, guys. Trend lines and channels both act as levels of support and resistance, but you don't always have a channel. Okay, so if price is only respecting a trend line at the top or the bottom, one of the two, a channel doesn't apply. And in order to be a channel, the two lines of the channel have to be parallel. Okay, they have to be parallel. If they're not exactly 100% parallel and respecting, you don't have a channel. Okay, we need to be picky about these things so that we make sure that what we're looking at is actually what we think we're looking at, right? Okay, so take a look here. We have a trend line down here at the bottom, right? Boom. Okay, low to low, draw a line. So now we take it, we mirror it, and you can mirror things in MT4. You mirror it and you move it up to your recent peak, which is right here, right? This little peak right here. And then you see it, then now we see, are we respecting it? So yeah, we are. We came up, we hit the trend line, we came down. Came up, hit it, came back down, right? The wick went above it, but the close was back below it, so that's okay. Came back down here. And you see that we're moving in this diagonal channel, right? Same thing over here. Low to low, line, put it up to the recent peak, line. You see we start respecting it, right? Respecting here and here, boom, okay? So nothing crazy there. It's no different than a sideways channel. I don't point this out when we talk about a sideways channel because it's obvious, but of course, the sideways channel lines are parallel, right? So they have to be for diagonal 1, 2. Okay? So another thing that those of you who have, been on Curtis's trainings before, he likes moving averages quite a bit, so do I. And they're used to determine the market direction or the trend. Okay, so another way to determine the trend, the moving averages are typically below the price in an uptrend and above the price in a downtrend. And you can look at the little chart here. Typically on our team, we use a 15 exponential moving average and a 50 simple moving average. So let's explain the difference in what these do, okay? All a moving average does is it calculates some number of periods back and it averages that price over, say, 50 candles, right? So a 50 simple moving average literally takes the last 50 candles, adds them all up, divides by 50, and gets an average, okay? And that creates this yellow line that you see. A 15 exponential moving average takes 15 periods. The only reason it's exponential is that it's weighting the current price heavier than the past price. So it takes, the first 5 candles and weights them heavier than the prior 10. And the idea behind that is that price right now matters more than price 15 candles ago, right? So why do we have 2 of them on the chart? We have 2 of them on the chart because they show different things. The 50 is what we call a slow moving average. It reacts to price slower because it's taking way back here into account. So you have a smoother line, right? The 15 is reacting to price more quickly. You can see how it's always closer to the price. And that's because it's only taking a little bit into account. So, we either use the 15 or the 50 moving averages. Sometimes you'll see that I'll do something where I'll use 3 moving averages. Okay, I'll use a 10 period moving average, a 30 period moving average, and a 50 period moving average. And I'll show you guys what we can do with some of those on future webinars, all right? So moving averages in general act as moving support and resistance levels. Not always, right? But a lot of times price will respect these moving averages. Take a look. We came up, down, hit the moving average, hit the 15, bounce, hit the 15, bounce, right? Again, eventually you break it, but, a lot of times we're respecting it. Boom, 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 boom. And you see that what we have is, again, like we said, in an uptrend, the moving averages should be below the price. The other thing we want, 2 other things we want. We want them to be in order, okay? So in an uptrend, I want it to be price, 15 moving average. Should always be closer, right? 50 moving average. From top down, price, 15, 50. Okay, if I had a 10, 30, 50 on there, I would want price, 10, 30, 50. Okay, they always need to be in order. Of course, in a downtrend, it would be the exact opposite. It would be price on the bottom, right? Followed by the 15 on top and the 50 on top of that. So in order to be a strong trend, we need the moving averages to be in order. The other thing we need is for them to be sloping in the right direction. They need to be pointing the right way. I don't want to be in an uptrend and have my moving averages start pointing down, right? Take a look. These are in order right here in this uptrend. You'll see they're sloping up, 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 sloping up, up, up. And then you'll see right here, the 15 moving average starts to hook down. Uh-oh, right? Uh-oh, what's happening? Trend's weakening. And take a look. It predicted it nicely. This slopes down. This 50 starts to flatten out. Remember, the 50 is always going to react a little slower, right? And that predicted the end of this trend for a while, right? And then we entered, a range, right? Actually, we entered some in this zone. We kind of got stuck. This would be consolidation in here. We got so tight that we literally stayed right in this range here. And then, of course, the price continued. But you see that little hook down of the moving average was a little bit of a signal. So, maybe this trend isn't going to keep going forever, right? You see right here, we also formed a lower low. The swing right here got broken, right? So a few things that we can look at to say this might be the end of that play, right? So we always want to be looking at when should we get in, but also when should we get out? What should we be looking for? Okay, another thing you can look at, and Christopher Terry likes these as well in his daily swing trades, are called Bollinger Bands. Curtis is actually really starting to like them as well. You see there's two main strategies when trading off a Bollinger Band, and you guys can, again, add these to your MT4. You can actually give them different standard deviations so that you can form multiple support and resistance levels with them. Obviously, the basic level is a 1 standard deviation Bollinger Band, but a lot of people use a 2.0 and a 3.0 standard deviation as well. Sometimes even a 2.5 in there. Okay, so you can add those to your chart and see what they do. Basically, they'd be Bollinger Bands on top of Bollinger Bands, right? So again, these are sort of like moving averages, just calculated differently, in that they act as support and resistance again. So the first play that we can make off of it is called the Bollinger Bounce. So the price reaches the top of the band, right? So price comes around, reaches the top of the Bollinger Band, and what does it do? It bounces, right? It bounces back towards the middle. And I want you guys to keep in mind that anytime we're playing a channel, anytime we're playing a Bollinger Band channel, anytime we're doing anything like that, we expect the price will eventually come back down to the bottom, right? And did it, up to the top, down to the bottom. Up to the top, we don't know, it cuts it off, but starts coming down. So one of your take profit levels can be down at the bottom of that range, right? But the safest, and you see with swipe trades, they give you a couple take profit levels, 2 or 3 of them, right? The safest bet is always 50% of the move, okay? And nothing's perfect, so you want to leave yourself a little bit of room, really more like 45% of the move, just because it may not hit the 50 exactly. When people expect something to hit a level, we know that it doesn't always touch that level perfectly. So people react a little bit early, and it causes the market to react a little bit early sometimes. So if I was going to do something like this, we would have our level. I would have a take profit just above the center of this, and then maybe another one down at the bottom of my band, all right? So, that way you're getting something out of it. What I don't want to do, what I never want to do, is lose a trade that I've won, right? That just doesn't make sense. So if price comes up here and then starts coming down and I say, yay, look at this go, and I don't do anything with it, and then it comes back up and breaks my band and goes, goes up here and hits my stop that's above my band, right? Well, now I lost when really I won. So don't get greedy and understand that the market's not going to constantly just go level to level, right? It might only go part of the way, okay? So, again, my take profits would be a little less than 50%, a tiny bit less than the bottom, okay? The second one's called the Bollinger Squeeze. So the slope of these bands and the distance between these bands matter. Okay, so the more these bands are sloping and the wider apart they are, the stronger the trend, all right? The stronger the trend. As they squeeze together, you start to come more into a ranging market. And as they get tighter and tighter, eventually it needs to break that range, right? So the Bollinger Squeeze, we wait for these bands to get close together. Okay, you see here they're far apart and sloping a lot. Here they get close together and start to straighten out. And mind you, the market was ranging right here too. It takes it a little while to react, right? Market was ranging. Now they start to squeeze together. You say, okay, well, something needs to happen. And eventually we break the band right here. So the band squeezes together. The candle breaks and closes above the upper band here. Okay, starts sloping up. And then boom, up we go, right? And price shoots up. Okay, so that's called the Bollinger Squeeze. Now, we're not going to do any of this stuff just based on these one thing, all right? I don't want you guys to just put Bollinger Bands on your chart and start trading the Bollinger Bands all night long, okay? Keep in mind that if anything was that simple, right? If anything was that simple, then everybody would do it and everybody would be fine, right? So it was just about waiting for the Bollinger Band to hit the top line. So what we need to do is use this stuff in conjunction with other things that we've talked about and see where it all lines up, okay? So let's keep going. Let's talk about retracements for a minute. Real simple discussion on retracements. This is advanced training, right? So we need to stick to as much advanced stuff as we can. A retracement is just a short-term price correction during an overall larger uptrend or downtrend. Okay? So it doesn't indicate a change in the direction of the larger trend. It's just literally what it's called, a retracement, a pullback, right? It's called a pullback or a price correction or a temporary reversal. And what it does is it allows you to enter at a better price. You don't want to be in an uptrend, up, have it get to point B and enter at point B, okay? You want to wait for it to pull back, okay? So we go A to B. If we pull back to C, we're going to enter at C, and then we're going to ride it out to D, okay, and get out. Okay, why do we enter at a pullback? Well, A, we know a pullback has to happen, right? We've talked about this before. Why does the market pull back? Why doesn't the market just go up? Buy. Wouldn't that be easy for everybody, right? Well, a couple reasons. Number one, by the time you've gotten to B, people who are entered at A are happy, right? You know, people who enter at A, some of them are happy, you know, halfway up B, halfway up this line, and they exit their position. Some of them are happy at B. A lot of people are happy at B. And people who have bought lower start closing their trades, start selling their position. That pushes the market down. The other thing is that people aren't always willing to buy forever, right? Imagine this to be an actual price. That's what it is. You know, I've told you guys before, if I offer you a car, I offer you a brand new Mustang for $500, who wants it? At A. $500 Mustang, everybody wants it, right? As we work our way up and that Mustang becomes $2,000 and then $5,000, people still want it. $10,000, people still want it. $20,000, people still want it. You know, $100,000, nobody wants it anymore. Nobody's going to buy at this price because people know eventually we need to have a retracement, right? So the higher this goes, the more people you have closing winning positions, the more people you have not wanting to buy, and the more people that are expecting it to come down eventually, so they start to sell, right? So that's why you have these retracements in the market. So we're only going to buy off of a retracement. We don't want to buy at the top, and we don't want to sell at the bottom. And that should make sense, right? So one way that we look at this is with Fibonacci levels, okay? And we use what's called a Fibonacci retracement. I'm not going to go into exactly what a Fibonacci is right now. I've done another webinar on that, and it's in IML, extensively. But they're used to predict the end of a retracement and continuation of a trend. Okay, so we're using these to find entry points. They're drawn from a swing high to a swing low. So if you were an MT4, you pick your Fibonacci, you go from your swing, in this case, your swing low to your swing high, you just click and drag it, and you would get a Fibonacci on the chart. And there's some important levels that we look at. An MT4 will do this for you. Basically what we're doing is looking at how big of a retracement, what percentage of this swing up got retraced. So if we start here and zoom up to here, if the price came all the way back down to this level again, it'd be a 100% retracement. That entire move got erased, right? If it only comes halfway down before it starts bouncing back up, it'd be a 50% retracement. And it's literally just a percentage game. You know, it could go 20%, 80%, whatever. And the important levels we look at are the 23.6% level, the 38.2, the 500, the 61.8, and the 76.4. And again, all these represent is what percentage of the swing was retraced. They act again as support and resistance levels. Okay, so there's a lot of different things we're looking at that all act as support and resistance. And what you guys should be forming in your head right now, and we're going to get there, is maybe we can find places in the market where all of these different types of support and resistance collide, right? Maybe they all happen at the same point. Okay, so we'll get there. If we retrace at a 38.2% level or less, it's known as a shallow retracement. The market didn't retrace all that much, and it points towards a stronger continuation of the trend. 50% tends to be the most common level. All right, that's going to be where you're going to see the most retracements happen to, especially off of a strong move. Okay, if you have a strong move, you should almost expect a 50% retracement off of it. Okay, a 61.8 level, it's called a deep retracement, so it retraced quite a bit, and that should tell you that if it bounces at the 61.8, the trend may continue, but it probably won't continue for long. Okay, it probably won't continue for long because there were a lot of sellers needed to push it that far down to begin with. And then once you get to the stronger, the even higher level, 76.4 and 100, those are reversals, right? A 76.4 is a potential reversal. I would not be looking to buy on a bounce on that. It's just too late. And of course, if it's 100% or greater, it did reverse, right? So you're not looking to do that either. Okay, then you'd have to be waiting for more confirmation of that trend before you get in. Okay? So here's a Fibonacci picture. Basically, we took it from the swing low to the swing, in this case, from the swing high, we dragged it down to the swing low. You'll see our levels came up on the chart, the 23, the 30, the 38.2, the 50, 61.8, 76.4, and 100, right? See, price came down, it bounced, and then you'll see it hit our 50 level, respected it, and again, everything's a zone, right? So don't worry that, oh goodness, it like cracked over it a tiny little bit. Everything's a zone. It can be perfect, but it doesn't have to be 100% perfect. I wouldn't want it to close above the level, but just ticking above it with a wick, that's okay. And then it came back down, and the original downtrend continued pretty strong, right? So that's all that you're going to do at the Fibonacci, the 50 level held here, and boom, continue to go. So remember that picture we showed back here, A to B to C to D, right? What does that look like on here? A to B to C to D, right? A to B to C to D. Where are we going to enter? At C, right? We enter at C right here. A to B, let it retrace to C, enter here, ride it to D. Okay? So that's what it looks like on a real chart. So let's talk about some entry point guidelines. So in a trending market, when the market's trending up or down, we're only going to enter trades at the end of a pullback, right? That's the A to B, C to D thing we've been talking about. Okay, in a trending market, we're only entering trades at the end of pullback. I don't want you guys to say, well, looky here, the market's coming down, and oh, look, right here, it's still coming down. I don't want you to enter right here and say it's a downtrend. Would that have worked in this case? Sure. But, no, it's not a very good practice because, look, price is literally right in the middle of this swing here, right? It's retracing this swing here. You don't have any kind of a bounce, and you don't have any kind of anything to prove. What if it respects that? What if it bounces off a Fibonacci level right here and boom, right, goes back up? You don't want to be in what we call no man's land, okay? So in a ranging market, we're only going to enter at the tops or the bottoms of channels. Be that a trend line channel, diagonal channel, or a horizontal channel. We're only going to enter trades at the top or the bottom of the channel. Nothing in the middle, all right? Because we don't know which way it's going to go. And any other area besides those two cases is considered no man's land. The market could go either way, so we don't want to get involved. For now, we're going to avoid trading in periods of consolidation, okay, like I said earlier. Later on, we'll discuss what a perfect triangle formation looks like, that you can actually play consolidation. That just won't be on this webinar, all right? So for right now, we can play in trending markets. We can play in markets that are clearly ranging. They need to be clearly ranging. Anything else we're going to avoid. Okay? So let's talk about what we can do. Uh-oh, my internet connection is unstable. I've never seen that before. We still all right, guys? Do you use this on the latest trend swing, or how far do you go back? So we can actually use this on multiple swings, all right? And you guys should have seen Christopher Terry do this before, and I'm going to talk about it as well. What I like to do is I like to do it on multiple swings. I like to do a Fibonacci from here to here, Fibonacci from here to here, Fibonacci from here to here, right? Not every little movement has to be considered a swing by everybody, okay? So some people, say that the market's up here somewhere, just let's say this is the top. Some people would draw their Fibonacci from here to here. Some people would draw it from here all the way down to here. And you can draw both, right? You can draw here to here, here to here, here to here, here to here, right? And we want to see if levels overlap, right? The more levels that overlap with each other, the stronger that area is, okay? So the main way, the basic way, is you use the most recent swing, okay? Again, here we're using this as the example. So this was the most recent swing where they drew it, but there's nothing stopping you from drawing more of those and seeing if other swings have Fibonacci levels at the same point, and that only strengthens your Fibonacci levels, right? Okay, so let's talk about that. It's actually a good segue into what I call convergence, okay? And this is a main part of my strategy, okay? So when I say convergence, I want things to run into each other, right? I want as much as I can to run into each other to prove to me that that level is strong. I don't just want to trade off a support level. It's not enough. But if a support level can run into a Fibonacci level, can run into a moving average, can run into something else, right? Now we just have a lot of points of confirmation that, hey, this level is strong. Every indicator we're looking at says that this level is strong. And you can imagine that brick wall that you see, right? The more bricks we have sitting there saying that it's a good wall, the harder it's going to be to pound through it, right? So price reversal zones are stronger when multiple indicators collide or converge at the same point, right? Examples. If a moving average collides with a trend line, boom, right? If a trend line intersects with the top of a channel, okay, that'd be resistance at the top of the channel, right? Fibonacci levels from multiple swings colliding. That's what Craig asked about. Strong support level aligning with Bollinger Bands. Okay, so those are all examples of two of them lining up. If you can get three or four of them to line up, then you're looking really good, okay? The more indicators that meet at a level, the better. And although not discussed tonight, I don't want to keep you guys on here all night in one night and give you way too much information, but although not discussed tonight, confluence with one or more oscillators is encouraged as well. Okay, so I don't want a bunch of things on my chart to line up and show me a strong resistance level, and then I say I'm going to go in for a sell, but then I look at something like the RSI, and it's dramatically oversold, right? If the RSI is mega oversold, then I don't want to really jump in for a sell right now, right? Even if those other things line up. So remember, like we said at the beginning of the webinar, you always need to be looking, A, why am I going to get into this trade? But B, is there anything sticking out that says, nope, maybe I shouldn't, right? It's better to avoid a trade than to lose a trade. So keep that in mind, okay? The market's always going to be there. We don't need to always be in a trade. If you're not in a trade right now, that's okay. I'm not in a trade right now, okay? So again, a little bit more on convergence. The probability of price bouncing off a Fibonacci level is higher if the level is also a common support or resistance level. So when you add your support and resistance levels to your charts first, which is how most people mark up their charts initially, and then start drawing those fib levels, you should see which Fibonacci levels are overlapping with support and resistance levels. And those are support and resistance levels you want to look at. Okay, not every support and resistance level is created equally, right? Even if it's bounced 100 times, it's not enough to just trade it on its own. So you should always be looking where those Fibonacci levels intersect them. A trend line intersecting with a Fibonacci level can also mean a stronger area, okay? And then again, using multiple swings to find areas of intersecting Fibonacci levels. And a big tip for you guys, and I'm actually, one of these weeks when we jump on here, I'm actually going to do a whole webinar on this. But use the harmonic scanner, guys, right? Again, one of the things we want to look at is price action, right? Market structure, okay? So the harmonic scanner does that for you. If you can have a harmonic pattern jumping into the picture right around a support and resistance level, obviously the harmonics are formed off of Fibonacci levels, which maybe intersect with, a Bollinger Band or something like that, that's just a really strong entry for you. So if you guys haven't logged into the harmonic scanner this week, you're crazy. You're absolutely crazy. And you should be looking at that, especially while you're new, to get starting points. Okay? Take a look. Remember, we're not going to enter every single harmonic scanner trade. It's a pretty picture that it makes on the chart, but it's still just one point of confirmation, right? But use that as a starting point because it's a free point of confirmation. It's a point of confirmation given to you by the computer, right? So make sure you're using that as well. I thought I was going to make a whole webinar without coughing. So the next thing we're going to talk about is correlations. And this is my strategy in a nutshell: convergence and correlations. Convergence and correlations. So currency pairs often correlate with each other. Knowing these correlations, you can gain confirmation for a trade on one pair off of the charts for another pair. Okay, so as a general rule, if the US dollar is on the same side of two pairs, they usually move in the same direction. So take a look, right? The Euro USD and the Pound USD, the US dollar is on the bottom of both of those ratios, right? So typically, more times than not, if the euro dollar is moving up, the pound dollar is going to correlate with that and be moving up as well. Okay? The exact opposite is true as well. If the US dollar is on the opposite side of two pairs, they usually move in the opposite direction. So the euro dollar and the dollar yen, right? Typically, if the euro dollar is moving up, you'll see the dollar yen is moving down. Okay, now I want you to take this into two notes, all right? Number one, I don't want you, I hate when I see people posting, results, win or lose, of buy on the euro dollar, sell on the dollar yen, and it looks like they have 6 winners, right? Really, all you're doing there, more times than not, is doubling down on your initial trade. Okay? There's often not a difference between trading a 2.0 lot size on the euro dollar or breaking it up between a 1.0 lot size on the euro dollar and a 1.0 on the dollar yen. Okay, they're more or less the same trade. Okay, if you buy one and sell the other. So keep that in mind, that if you're in a trade on the euro dollar and you see a setup for the dollar yen, you may or may not want to take that. You may or may not be over leveraging your account on the same trade. Okay, so what about cross pairs? What about pairs that don't have the US dollar in them at all, right? What we call exotic pairs or cross pairs between the US dollar that don't have the US dollar in them. How do we deal with correlations for those? So I'll tell you, I've traded for 10 years. I don't have this memorized, all right? And honestly, to be honest with you guys, I don't really look at the cross pairs all that much, okay? The pairs that I trade myself are the euro dollar, the pound dollar, the Aussie dollar, so the Australian dollar versus the US dollar, and the dollar yen. Okay, those are the 4 that I look at. I have them all up on my screen at the same time because now, based on correlation, I know that the euro, the pound, and the Aussie should be going the same way, right? The dollar yen should be going the opposite way. And that gives me 4 different pairs to look at for correlation. If you want to look at the correlation for these cross pairs, Oanda has a good heat map that you can look at. So here's the link for it if you guys want to screenshot that. Or you can just Google Forex correlations, and it'll be one of the first results. If I click on it and bring this screen over here for you guys, this is what it looks like. So you can either have a bubble map where the bubble's bigger if it correlates more, or you can change it to a heat map here, which is what I like. So the more red it is, the more it correlates positively with a pair. Okay, the more it goes in the same direction. The more blue it is, the more it moves in the opposite direction. If it's no color at all, then it really doesn't correlate. And you can kind of hover over here to see the correlations as well. So you'll see right now, we're comparing everything to the euro dollar, right? How do these pairs correlate with the euro dollar? So you'll see that, like we expected, let's see if I can find it. Where is the dollar yen on here? USD, JPY. Okay, you'll see that pretty much everything with the US dollar on the other side is blue, right? You'll see the US dollar CAD. Typically, be a little bit conservative with this. The dollar CAD, the Canadian dollar, doesn't always correlate with the dollar, with the euro dollar, right? Lately it has been, but you'll see that the rest of these, the dollar yen, very strong negative correlation. And these are just different time frames. So how much has it done in the last day, the last week, the last month, the last 3 months, 6 months, year? So let's go back to the dollar yen here. And you'll see that over the last year, it's had a negative correlation, right? Just like we expect. If you come up to something like the Swiss franc, the US dollar Swiss franc, negative correlation. USD is over here, right? If we pick one where the US dollar is on the same side, something like the pound dollar, right? You'll see that, in the last hour, it might not be correlating. Nothing's perfect, but overall, positive correlation. US dollars over here, right? And then you can use this for cross pairs that we don't know, right? The Aussie yen, what does it do? Well, it tends to correlate moderately, sometimes strongly, with the euro dollar in the same direction. And you guys can use this heat map as much as you want. If you want to compare to something other than the euro dollar, you just click on the pair. So if you're looking at the US dollar versus the Swiss franc, and you want to see how things compare to that, just click it. Now we're comparing against that, and you can do that. Okay. So that's how correlations work. Now let's talk about what we're going to do with them. Okay. So when you see a potential setup on one pair, we're going to check other pairs that correlate either with or against it to look for confirmation. Okay. You're also going to look for reasons not to take the trade, right? Like I've said a billion times in this webinar. So if I find convergence, right? All of our support and resistance type indicators running into each other on a pair, right? And I'm looking for a trade. And I go and look at another pair that's correlating, or 2 or 3 other pairs that correlate with it. I want to find convergence there as well. Maybe not as much. It doesn't have to be the perfect setup on every single pair, right? But I want to find something that tells me that it's good, right? Maybe if I'm looking to buy the euro dollar and I look at the pound dollar and there's a big support level that it's coming to. That makes me happy, right? Or I look at the pound dollar and it's super, super oversold. That makes me happy that my euro dollar might go up, right? But in the same respect, if the analysis on a correlating pair points to movement in the opposite direction expected from your correlations, you might want to avoid the trade. Okay? And looking at other pairs, just tells you, is the market in agreement with each other, with itself, right? I don't want to have the euro dollar look like it's going to go up and the dollar yen look like it's going to go up, because eventually that correlation is going to resume and one's going to go up and one's going to go down, and we don't know which one it is, right? So this will lead to taking higher probability setups as the market is in agreement across multiple pairs. All right. So as an example, and here's your test for right now, guys. You identify a setup to sell the euro dollar. Sell the euro against the US dollar. When checking your correlations, you see that the US dollar Japanese yen, the dollar yen, is approaching a strong resistance zone. Do you take this trade or not? Let's see some answers in the chat box if we can. So again, we identify a setup to sell the euro dollar if we want it to go down. But when checking the correlations, you see that the dollar yen is approaching a strong resistance zone. Do we take the trade? Okay? And the answer is no, we don't take the trade. Okay, why? Because we know that the dollar yen is supposed to correlate inversely to the euro dollar, right? So if I'm hitting a resistance zone on the dollar yen, right? If I'm hitting a resistance zone, let's see, let's find the good chart. Okay, if I'm hitting a resistance zone on the dollar yen, I expect the dollar yen could possibly turn around and come back down too, right? So I don't want to be against the correlations. If I expect the dollar yen may come back down, then I definitely don't want to be betting on the euro dollar to come down as well at the same time, right? So this would be no. This would be one where I identify a good setup to sell the euro dollar, but the dollar yen says, hey, now hold back a minute. We're not in agreement with each other. One of us isn't going to go down. We don't know which one it is, so let's stand back and wait for a better setup, okay? So the answer to this is no, okay? I want to make sure everybody understands that, okay? So guys, that's going to be the end of the training for tonight. I want to take a little bit of time before we answer questions just to congratulate some members on the team as far as results go, just to show you guys what people who are using these tools are pulling off. So obviously, Justin Ford is the leader of Team Take Profits, right? Really, really good friend of mine. We work together very, very closely. Take a look. Not bad. Made over $4,000 in a few hours on my cell phone trading Forex. Pretty crazy, right? Let me see all the winners right there. And then he said over here, this is a separate set of trades from today, actually. Closed out all the open trades and doubled my account in 3 days. Next week, I'm going to turn it up. Win-win, obviously some losses. You're not going to win everything, right? But literally, 415 and $4,000, $4,400 in a couple of days. Awesome. Here's Casey Jackson. I usually wouldn't hit you all with back-to-back posts about this, but I'm so excited. I woke up to $200 in profits while I slept, and in the last 2 days, I've grown my account by $280. Here's Michael Paul. I think Michael's 18 years old. He's here in Michigan in the Detroit area. We hang out a lot at the opportunity meetings and events here in Detroit. Really good kid, and he's gonna kill it. He's still in high school. He made $15 in less than 10 seconds. It's pretty good, right, for being 18. Look, and these are with 0.01 lot sizes, 10 cents a pip, and he made $15, right? So 150 pips in that movement. Okay, check this out from India. And keep in mind, guys, that in India, I think the rupees, it takes like 60 some rupees to be $1 US. So here's a couple days of his trading back on the 16th a few days ago. Boom, $80 profit for the day trading Forex. Multiply that by 60, and that's how many rupees he got over there, right? Crazy, 4,800 rupees. And then today, 6 hours ago, yes, $240 profit for the day. Crazy amounts of money over there, guys, and I'm really excited for him, right? Rob, a good friend of mine here in Michigan, we work together. Check it out. Swipe trades are going off. Yesterday's signal is up 100 pips. Profited $70.86. And then on the 16th, again, another IMarketsLive swipe trades going off. Profited $195.57. Guys, if you're not taking advantage of swipe trades, it's absolutely on fire. All right, you're just giving away money if you're not using it. So go use it. Here's Tom, another really good friend of mine. I'm here in Detroit, here in Michigan. Started the morning out with a $68 and ended it with $121.20. Justin Adams is on fire, and swipe trades is completely different. Blah blah blah. Right? Huge amounts of profit being posted in our team. Rob says I need to post my results. I made over $400 this week. Crazy. All right. So keep that in mind, guys. Just look at the potential here between A, using the tools that you have, and B, learning how to do this yourself. You have everything you need here to kill it. You just need to put in the time. So what I want to do, quick recap, is that here in week one of this training, the main things we went over, just a quick review on some of the different indicators, different ways to determine trend. And then what I want you to take out of tonight is that we're looking for convergence, and we're using correlations to either verify or de-verify, I don't know a better word than that, what we find on our initial pair, okay? So again, convergence and correlations. Convergence and correlations. That's all this is. All we're looking is to build as strong of levels as we can, verify that the market is agreeing with itself, take the trade, all right? And in future webinars, again, I'll be on here every other Friday. We'll talk about exact entry points, exact exit points, using the oscillators, and a bunch of other things as well that go into it. When do we get out, right? What if the market sentiment changes? How do we tell that maybe we shouldn't ride it as far as we initially thought? Things like that. And again, we'll do something completely involving the harmonic scanner. how do we use the harmonic scanner to more quickly find points of entry, to more quickly find verification, right? So we have a lot to do, but what I want you to do is go back to your charts and start trying to find these areas, be it with Fibonacci levels, be it with moving averages, be it with the combination of everything we talked about, where these things intertwine, where these things converge and collide with each other, and see whether or not the market reacted positively, right? And, we'll go over more on how to determine fake outs and stuff like that as well. When the 15 EMA crosses the 50 SMA, does that tend to lead to a trend change? What I want you to keep in mind, Craig, is the moving average, and really every indicator is, but the moving average is what we call a lagging indicator, right? It's basing everything off of past price. Really, with a 15 and 50, the 50 is basing it off of price 50 candles ago. So it's lagging, it's slow. It doesn't catch things in real time, right? So when you have a crossover, does that typically lead to a trend change? Yes, but a lot of times the moves mainly already happened. Take a look. Right here, coming up, we had a crossover, right? The crossover, it looks nice here, but the crossover really didn't leave much room for a move. Here we crossed over. Here we crossed over, right? We crossed over right here, and, it continued down. So a lot of people who just try to play the crossover get burned, period. It's not enough. It's not reliable enough. And remember to some degree that the periods that we're choosing on the moving averages are arbitrary as well, right? So, okay, the 15 crosses the 50. Well, where do 15 and 50 come from, right? What if a 10 crosses a 12? Is that good? You never really know. So to me, I don't care about the crossovers at all as far as entry points go. Okay, a crossover when you're in a trade. When you're in a trade, it's a crossover a valid reason to potentially get out. Yes. Okay. So I want to make that distinction clear. Crossovers for entries, no way. No way, no way, no way. Crossovers for exits, you can take them into account. Okay? Using the RSI, MFI, and EDX. Okay, awesome. Curtis has a lot of experience with the MFI, or at least a lot more than me. I don't personally use it, but he will be on these trainings as well, and he'll explain the MFI to you guys in stochastic. Yep. So sounds like you've been on Curtis's trainings before. Is that true, Craig? Awesome. Yep. Sweet. That's what I like to hear. Being on everything. Cool. So let's go ahead and keep fielding some questions here. Maybe I won't kill the slideshow. Okay. Everybody else has been quiet tonight except you, Craig. We get a question from anybody else? And it doesn't have to be specifically on what we talked about tonight if you don't want. It's 9:18 now, so we can give it another 10 minutes of questions or so if there's enough questions. Another example of correlation, sure. So let's actually pull up the charts, right? And I don't want you to be afraid of my charts, okay? If Curtis was on here right now, he'd say, don't look at Matt's charts, right? They're a little bit messy. And there are things that we'll talk about. I want high probability setups when I take a trade. So there are other things that we'll add as we go along, but I don't want to confuse you guys right now. I don't want to pile every single thing on you. So in honor of Curtis, I'm going to change my template to the Curtis template, right? And I have a Curtis template on here. And this probably looks more like what he teaches you, right? You have your 15 moving average, your 50 moving average, and your 7-period RSI, okay? So that's what Curtis typically uses to teach you guys. He might have the MFI on here. He might have a stochastic on here, right? But as far as correlation goes, take a look. So I'm on a 4-hour chart on the euro dollar. I'm going to zoom it out a little bit, okay? And you see that overall the euro dollar has been in an uptrend, right? Euro dollar is in a pretty long-term uptrend. You see back here, this is April, right? So April 12th of 2017. From there all the way to October, we've been in an uptrend. Now you'll see that down here, here's somewhere where you would mark up as a support level, right? Other than that, you don't have a whole lot on this chart right here, and you can always zoom back, but you don't have a whole lot of support or resistance. You've been in a pretty clear trend. You know, you could look down here, you had a few bounces, but that's obviously far away from where you were. Overall, in an uptrend, the moving average, now you start to see the moving average here. Right here is where we talked, right? What about the crossover? So we came up, we came down, right? Moving average crossed over right here. See how that's late? See how our move already happened, right? Up we go, down we go, move already happened. Okay, so the crossover didn't save us at all there, right? The market ended up coming back up, we crossed over again, and you'll see here we're in a little bit of a channel, right? So we can add a couple lines here. They're all gonna be white for right now, just for the sake of time. But you know, you see that you had a little bit of stuff respecting right there. You know, to me, these tops don't matter too much, okay? Because again, this did form a higher high here, so I wouldn't necessarily put a top here. But you'll see that as far as what we call mean reversion, you have a level that tends to stay steady in the center right here. Okay, so I'm not so worried about this top right now as I am with this center level here where the price tended to keep pulling back to. Does that make sense? So, you know, somewhere in, oops, come on, line. Somewhere in here, okay, you see how the price tended to always, for a while, it always ended up there, right? It said, oh, I'm going to shoot up above it, I'm going to come back down to here. I'm going to shoot up above it, I'm going to come back down in here. I'm going to bounce off it, but right back there. I'm going to come down, right back there, right? So, not every single zone, and this is stuff that we'll go into more detail on later. You know, different things like, and you'll see Christopher Terry when he does swing trades. Different things like the lengths of the swings, the market structure. You know, he talks a lot about Elliott wave analysis, right? All the different stuff that we'll have to go through. But you know, you don't have to just be looking for support and resistance. Look for different patterns that like stick out to you, right? So price here tended to always get back to this middle zone. Okay, so many people draw this line up here, when to me it didn't support or resist anything. It came up here, came down, it formed a new high, it came down, it never went up there again, right? So I don't want you guys, and I see it a lot, I don't want you guys to be putting lines at the top of every swing. Okay, this swing right here isn't resistance. It's just a swing, right? The market just swung up to it, came down, and continued its trend. It's not resisting anything. It just pulled back a little bit. So I see a lot of people that literally have a line here, line here, line here, line here, line here, line here. It gets up to this line, you know, it comes back down to that line, and, you know, I don't know what they do with it, right? It's just too much, right? So you needed to actually have respected that level. Okay, so how many touches for a support or resistance? The baseline is 2, right? So you needed to at least respect it once, but you're not going to enter off that second test, okay? You need at least the third time to enter, and a lot of times you need it to do even more than that. You know, so in here, right? You know, to me, this isn't support. This is, but it isn't, and I'll tell you why, right? So here, the market came up, bounced, but then it basically got stuck, right? This isn't like it swung down and then came and retested it and bounced again. It just got stuck. Okay, when you zoom in a little bit here, it might look a little bit nicer. Oops, hold on. Let's make sure we're looking at the same spot that we were looking at before. Okay, so right here, right? Okay. So it really didn't respect it a bunch. It just consolidated in this little zone, right? It barely moved. Okay, yes, it respected it, but it's not like to me, this is it. It's respected it once, and then it just got stuck. The market just didn't move for a while. So it came up. It might have respected it once in here. It respected it a second time here. Not going to trade off the second one. So now this is a potential resistance line here, but now we never respected it again, right? We came down, we hit, we bounced, we came up here, we broke. So now you could be looking for that potential breakout play, but why wouldn't I have taken this trade? Look at the RSI, right? Yes, it would have won, okay? You can always look back and say something would have won. That's fine. But, in real time, you need to be playing it right? So here we broke out. Could you take the trade where you set your stop loss right back in this zone and you buy it because we broke out with a nice green candle? Sure. Two things I don't like about this. One, you'll see that it actually reached way up here, right? You'll see that wick, but then it pulled back prior to the close. That would give me the potential to say, well, it might be coming back into our zone, right? This isn't a strong green close. It went above it and then it closed above it, but it was pulling back at the time it closed, right? The other thing I don't like on this is the RSI. The RSI is really oversold right here, right? Right here it was at a value of 91.7. It can only go to 100, right? So we're really oversold, or we're really overbought here, sorry. So I don't want to be entering a breakout buy when we're really overbought, okay? But what could you do? Here, you come up, you come back down a little bit, right? Now you respect this level, okay? Now again, remember, I want to see this act as resistance, or act as support, sorry, before I count it as support. Okay, we counted it as a resistance level over here. I still haven't seen it act as support, so I'm not in here either. Okay, I'm picky. So this move would have ran away, right? Here you have some moving average bounces that you can look at, but to me, there's not a whole lot in this zone, okay? Where do you start to have a potential setup? Well, let's take a look here. Okay, potential setup is where we're looking for convergence, right? So what you need to do is start putting Fibonacci levels on here. Start looking at your channels that you have. To me, the thing I like most on this chart is what we looked at here. This level of getting stuck in a mean reversion type state. Okay, and down here at our bottom, we have a pretty clear bottom here. So I'm going to remove this line. If it will let me. Come on. I'm going to remove that line. And I'm going to look at this zone right now. Okay? And this is what I would be looking at moving into next week. Okay? So this is the zone we're looking at. We're still in an uptrend. Okay? And we're not really in any kind of channel right now. To some degree, we have the strong bottom, right? But we don't really have a strong top. So we're still in an uptrend. So in an uptrend, what are we looking for? We're looking to buy, right? It's for simplicity's sake right now, we're looking to follow the trend as much as we can, right? Why not? So we're only looking to buy in this market. So this market comes back, but we're also not looking to buy in the middle, right? This is literally no man's land. And if you draw a Fibonacci level, let's do a Fibonacci retracement level, between the top here and the bottom here, right? Do you see what I see? And I did not plan this before the webinar, guys. But do you see what I see? That level that I put in there as far as the mean revergence level, or mean reversion level, is pretty much right on top of that 61.8, right? Right on top of that 61.8 level. And of course, this was a somewhat arbitrary line to begin with because I didn't really measure it. I didn't measure it to come down to half of this area. Really should be up a little bit more. I don't want to move it just to make it look perfect. But, really half of this area that it's starting to get stuck in is really right about, halfway between these candles, right there, okay? So I like that level here as potential resistance, right? As potential resistance. That's two things that are lining up. So now what am I looking for? I'm looking for price to push back down, right? Maybe it'll get to the bottom of this zone. Maybe it won't, okay? But I'm looking for price to push back down. We're starting to get near the oversold. So if we can push back down, our RSI is going to start to be oversold down here, right? I'm going to look for an entry point for a buy on this eventually. And when that plays out and I take the buy, I'm going to start getting out at these levels, right? With my take profit level, my main take profit level is going to be where? Somewhere below the 61.8 that I think we're going to get stuck at, right? Because I have a Fibonacci level intersecting with my mean reversion level, and I'm sure that if I look at this, and let's just take one more swing, okay? Let's just take one more swing to see what happens. The market swung from here up to here, and from here up to here, right? So let's insert two more Fibonacci's. And let's just go from here to here on the first swing. Okay, boom. And let's take another swing. And this is where it starts to get into a little bit of advanced training, guys. This chart is going to start to look pretty messy, right? But if I take this to the top of this swing right here, take a look what we have now. Remember our level? Now we have a 61.8 intersecting with our mean reversion level where price seems to like to come back to, intersecting with a 23.6 of the last prior swing, right? And do you guys understand why that starts to become a strong zone? Because you have a lot of things running into each other, right? So what I'd be looking for, I don't want to sell this if it hits it, because again, we're still in an uptrend. We would have set a new high for it to get up there again, potentially be moving up. You see that we actually are in a bit of a downtrend here, previously, right? So it really depends how you look at the market, right? How far back do you look? If you look back till April, we're in an uptrend. If you look back right now, we're in a mini downtrend, actually back since September, so for the last month. So what I don't like about it is that in order to get back up here you have lower high, lower high, lower high, right? Then you set a higher high. Now you have a lower high again, but to get up here, you'd have to set another higher high, right? So 2 out of our last 3 swings would have been higher highs, which would have, to get back up here, it would have erased this swing, this swing, this swing, that swing. And definitely, well, obviously a 61.8 of this swing, right? I didn't draw this one here, so it's actually probably more. But you have to erase too many of your downtrend swings to say I'm going to sell right here. But I'm looking at this level as support because again, we tested it, right? We're good. We have a lot of tests of it. I'm looking at that as potential support in an uptrend where we'll be oversold when we hit it, right? And then I'm looking at this as potential resistance where we have strong level that form. So again, our take profit levels would be a little less than 50% of the zone, whatever the distance between white line A and white line B is, a little less than 50% of it for TP1, right? TP2 is going to be a little bit less than this zone here, right? And that's it. Nothing crazy. Okay, so will this play out? We don't know, right? Right now, it's in no man's land, right? It's clearly in no man's land, right in the middle of all this mess, right? So, is this a potential setup? Yes. Is it something you jump in right now? No. You have to wait for it to play out and see if that trade develops. All right, so that's my trading strategy in a nutshell, guys. Obviously, more we have to go over, but we've been on here for an hour and a half, so I definitely appreciate the questions from Craig. But there we got a nice random setup there for you that I didn't pre-plan. That you see that things do intersect like that. When analyzing charts for support or resistance, do I start with the weekly or the daily? Angela, I start with the daily myself. I like to use the weekly more as a overall trend type of thing. So I don't need it to be, but it's extra confirmation if the weekly trend is following the trend I'm looking for. And it's even more confirmation if I'm looking to buy, if I can get it oversold on the weekly, right? Now, of course, what you need to keep in mind with on the weekly or the monthly is that if something doesn't go your way, then you have to wait at least a month for it to, right? Or at least a week for it to go your way. So I don't like to be too picky on the weekly chart because if something doesn't line up, I don't want to have to wait 3 or 4 or 5 or 6 weeks before I ever even look at that pair again, right? But that being said, you can find support and resistance levels on there. You can find things that intersect, and when they intersect there, that's the stronger the time frame, to some degree, the stronger the level, right? When you start to get past the daily chart, at some point it's arbitrary, right? I guess what I'm trying to say is I wouldn't try to line up support and resistance levels on a 5-minute chart and try to be scalping 5-minute trades, right? To me, typically these first 3 options, the minute, 5-minute, and 15-minute, don't even exist. Okay. how do I pair my tabs on MT4? Good question. So mine actually looks like this. Okay, let me set it up. How I typically do it. I have the euro dollar here. I have the pound dollar, and I make it show. I'll just make a Curtis template for now for you guys. I have the Aussie dollar, and I have the dollar yen. Dollar yen, where are you? Right here. Okay. So these are the ones that I look at. Template, Curtis template. Let's bring this one up. Template, Curtis template. And then you can actually go up here to your window and tell it to tile it. And then I have all my charts right there. And this is how I look at it. All right. And you'll see these ones aren't all on the right time frames. You can change all the time frames on them. But this is what I look at. All right. So euro dollar, Aussie dollar, pound dollar, dollar yen. And now I can see all my correlations and everything I want. So take a look, guys. Euro dollar is heading up, right? And these are in different zooms as well. So let me fix it. Euro dollar is heading up. Pound dollar is sort of heading up, not really. So this would be a little cause of concern. Dollar yen is heading up right now too. Right? Okay, uptrend on the dollar yen. Aussie dollar is heading down. Okay, it's actually in a channel. Okay. Oh, are we back? That was weird. It muted me. I don't know where we started. Where I left off. It muted me by itself. But so you can see right now the correlations aren't playing very well, right? We would expect up, 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 down, and we don't have that right now, right? We don't have that at all. Again, today's Friday, so remember that the market typically reacts differently on Fridays because people aren't looking for setups so much as they're looking to get out of their positions, right? Retail traders, even banks and whatnot, are looking to close positions heading into the weekend. People aren't looking to buy or sell heading into the weekend as much. So on Fridays, you might not see the same correlations that you'll see during the week. Okay, so right now, I would need to see these correlations start to resume before I look for that euro dollar trade, right? If that euro dollar trade were to play out right now, would you take it? Probably not. No, because these correlations just aren't playing nice, right? Okay. So hopefully you guys can see that on the charts now, how that kind of plays out. Let's give it another 60 seconds if a question comes in. And if not, we'll close it out for the night. This will be recorded, guys. I'll get it edited and sent over to Justin. And again, we're literally probably days, less than a week away from getting the website up and running for the team. I just need to catch a little bit of time to do it. So that is seriously coming for you guys. Let me just real quick show you guys the training schedule one more time so you guys can screenshot it and get ready for the next trainings. So right now we're right here, trading with me on the second week of the month, right? We're actually the third week of the month, but I did it anyway. So there we go. So I guess we're not in the third week, so we're not in the second week. So no training tomorrow. The next training will be marketing training with Joe on Monday. Then we have Freddie marketing training on Tuesday. So guys, even if you're not recruiters, even if you don't feel like building the business side, of it, take advantage of these calls. You know, they're skill sets that you can always put into use somewhere. All right. You have big, you literally have guys that have made hundreds of thousands of dollars in the industry. Freddie's maybe made more than that. Willing to train you. So take advantage of these. Obviously, live opportunity meeting on Thursday, and then I'll be back with you next Friday. So because I don't know dates, you guys actually get me 2 weeks in a row, right? I think the reason is there's apparently 5 months in the week, so it screwed it up a little bit, or 5 weeks in the month. And then next Saturday, you'll have Jay Wayne teaching trading basics. So, you guys can hop on there as well and get a refresher of your basics, bring your new people on there, and everything like that. So, guys, I definitely appreciate you all coming out here. Again, this recording will be up soon. I hope that helped. I hope that gave you a little bit of a taste of what I look for. And remember, everybody's strategy can be a little bit different, but what you need to do is prove that your strategy wins over time. Okay, so I know we still have a lot more to go over as far as what counts as convergence and what doesn't, how much needs to converge, when it needs to converge, where we're riding trades out to, stuff like that. But for an hour and a half, I think we got through quite a bit tonight. We got through enough of the basic level stuff of going over the indicators. If you guys aren't familiar with any of those indicators, okay, you aren't familiar with anything we went through tonight and you need more on it, that'd be something to ask in the basic training. That'd be something to go back into IML Academy and watch, right? Ask it in IML TV. Support or resistance, trending and ranging, right? Trend lines, channels, moving averages, Bollinger Bands, retracements, Fibonacci, right? If you guys aren't familiar with that kind of stuff, go get familiar with it. All right. I don't want to sound mean, like I won't teach it to you, but it's all back there, right? And I want to try to utilize this time that we have together to show you more advanced things and show you how you're actually going to turn this into profitability. Okay. On that note, I'm going to call it a night, guys. I definitely appreciate you all coming out, and we will see you guys soon. So I don't have any music like Justin typically puts on. Didn't plan ahead, but we will see you all next Friday. If you have any questions, make sure you post them in the Facebook group. We can answer them as we go along throughout the week, and we'll see you guys soon. Take care, guys. Have a good weekend.